Every crypto bull market promises freedom from the old system. No banks, no gatekeepers, only math. And yet the most used tokens in the entire ecosystem aren't gambling chips or moonshots. They're dollars, blockchain dollars, moving trillions every year while trying to do one humble, impossible thing: stay at $1, €1, one stable unit. Here's the paradox that never makes the marketing slides. If these coins live on blockchains, why do their lives depend on the same fragile peg mechanics that have cracked again and again throughout history? If trust is decentralized, why does the peg still live or die off-chain? Debt, currency, and confidence have always formed a triangle. Stablecoins are simply the newest attempt to bolt that triangle to the floor. The story begins before blockchains, before computers even, with the oldest peg of all. This note equals that metal. Gold standards dressed their promise in the weight of bullion. Bretton Woods layered a treaty on top, allies pegged to the dollar pegged to gold. It held as long as redemptions were polite and reserves were sufficient. Then came the reminder that no peg is a law of nature. When the math diverged from the promise, too many claims, not enough metal, nations lined up at the window. The window shut, the peg broke, curtain down. Currency boards applied stricter arithmetic. Hong Kong S-Board still insists that every unit of local money can be redeemed for a matching stock of US dollars and T-bills. Argentina tried a version in the 1990s with convertibility, and for a time it worked with numbing regularity, until it didn't. Speculators tested, reserves thinned, politics intruded, and the peg surrendered. This is the rhythm of pegs: tranquil summers, violent autumns, calm while flows are in balance, crisis when redemptions race ahead of the collateral that backs them. A peg is a contract with a clock. On-chain dollars inherit this ancestry in three main species. The first looks familiar: fiat-backed custodial coins. A company issues tokens and holds cash, T-bills, and overnight repo as reserves. The rule is simple. If the token trades at 99 cents, buy it, redeem it for $1 through the issuer, and pocket the spread. If it trades at $1.01, mint new tokens against dollars, sell them, and compress the premium. Arbitrage becomes the invisible market maker. The peg hovers near 1 because traders enforce it for profit. The second species is crypto-collateralized and algorithmically disciplined, but not purely algorithmic. Lock volatile assets in a vault worth more than the stablecoins minted against it. If the collateral falls in value, rules seize and sell it to keep the system solvent. Fees, auctions, and oracles govern the dance. It can be robust as long as liquidators show up, price feeds stay honest, and the chain keeps breathing under stress. The third species is reflexive and seductive. Algorithmic pegs that hold $1 because the design insists the system will reward everyone for believing so. A sister token absorbs volatility. As long as demand rises, the peg glides. But when belief is the collateral, doubt is a sledgehammer. A shock hits, the sister token plunges, and the market asks the only question that matters: backed by what? If the answer is by belief, the story writes itself. Behind every species stands the same machine: redemption, reserves, and a buyer of last resort. Redemption is the rail that converts tokens back into the collateral at par. Reserves are the oxygen tanks: cash, T-bills, repo funding that can be sold instantly with minimal slippage. The buyer of last resort may be a central bank in fiat land, but on-chain it's a composite character. Issuers leaning on banking partners, arbitrageurs chasing spread, market makers warehousing inventory, and at times the protocol itself. When all three parts hum, the peg feels like granite. When anyone jams, the stone becomes foam. Consider why the decentralized dollar remains tied to the old world. The collateral stacks live in custodial accounts. The T-bills settle at the U.S. Treasury. Wires move through a payment system that naps on weekends. The blockchain never sleeps. Banks do. This creates a weird physics. Prices on-chain move at the speed of rumor, while reserve verification moves at the speed of paperwork. A Friday scare can punch a hole in the peg within seconds. The proof that nothing is wrong may arrive Monday after lunch. Stablecoins are, in essence, private currency boards for the dollar, issuing digital liabilities against short-term U.S. assets. That's not a bug in the design. It is the design. Stress reveals this design in cruel clarity. Algorithmic pegs fail like bridges without rebar. Elegant lines, no steel. There is a living memory of this, days when a reflexive system unwound in a straight line downward, destroying trust with mechanical precision. There's also the subtler wobble of custodial coins. Even with tons of T-bills, a credible whisper of exposure to a shaky bank can widen the bid-ask. Traders hesitate to catch a falling knife. The token prints 98 cents and then 95, while everyone looks at everyone else waiting to see who blinks. Redemptions eventually reopen, spreadsheets eventually publish, and the peg snaps back. If the assets are liquid, if the pipes are open, if someone writes a very large check very fast. Crypto-collateralized pegs meet a different test. When the market plunges and oracles lag, auctions must clear instantly. If liquidators go on strike for even an hour, the peg stutters and bad debt forms. Survive the gauntlet, and the system proves itself. Fail the gauntlet, and the token learns about gravity. What keeps the project alive in good times is what pays the bills, the spread. $1 equals $1 is not a business model. The carry-on reserves is park billions in T-bills at a comforting short duration, clip the coupons, and pass none or little of that yield to users. Stability is the product. The yield on collateral is the profit. The arrangement resembles a private money market fund that runs at blockchain speed. In a low-rate era, this looks uninteresting. In a high-rate era, it prints cash. Users accept the trade because they want the utility. Near-instant settlement, easy programmability, and access across borders. The hidden cost is concentration of risk. Ordinary holders float happily while the issuer and its counterparties warehouse the tail. When tail risk materializes, the wealth transfer is sudden, and it always travels uphill. None of this is unprecedented. Offshore dollars became the world's quiet power line decades before any smart contract. The euro-dollar market allowed institutions to hold and move dollar claims outside the United States under different rules at high speed. Money market funds turned short-term instruments into deposits that weren't called deposits. Stablecoins are their on-chain twins. They import the dollar's stability and the dollar's politics, and in places where local money flickers in and out of usefulness, that import feels like oxygen. A blockchain dollar allows a merchant in an unstable economy to settle trades without asking permission from a local bank. It also invites the rules of the network it mimics. The closer a coin gets to being indistinguishable from the dollar, the more it inherits compliance and blacklist powers. The farther it drifts to avoid those powers, the more it inherits market risk. Choose a poison, regulation or volatility. Governance sits at the center of this trade. Code enforces rules, but committees set them. Issuers decide reserve mix, redemption terms, and the extent of blacklisting. Protocols decide which assets qualify as collateral, what haircuts they carry, which oracles tell the truth, and how punishments apply during liquidations. Emergency powers lurk in many contracts. Pause buttons, circuit breakers, freeze lists, those calm regulators and surprise users. The brutal truth is that absolute decentralization and a hard peg don't coexist for long. A peg benefits from discretion in a panic. Decentralization treats discretion as a bug. Most stablecoins live in the mushy middle. Enough control to rescue the system under fire, enough openness to keep adoption climbing. Understanding how pegs break, on-chain or off, requires only a handful of categories. The first is an asset-liability mismatch. Redemptions show up faster than assets can be sold without moving the market. Money market funds know this wound. It opens quickly and bleeds fast. The second is an information shock. Facts matter eventually. Headlines matter immediately. A credible rumor about reserves, legal action, or a banking partner can send rational sellers for the exit first and questions later. Liquidity vanishes before spreadsheets are posted. The third is an execution failure. Crypto-backed pegs demand seamless liquidations, clean oracle prints, and available balance sheet from opportunistic buyers. During chain congestion or cross-market chaos, any link can freeze. The fourth is design reflexivity. A system that uses the value of its own governance token as a stabilizer may be written for fair weather. When the tide turns, the stabilizer becomes the spark. Healing has a checklist. Open the window and take the mystery out of redemption. Par at scale is the only message that matters. Show the books in a form that markets trust, not vibes, data. If necessary, borrow a backstop from deeper pockets. In past crises, private lines from well-capitalized institutions created floors that public tweets could not. Clean the portfolio, shorten duration. If the peg must be boring to be credible, make it boring again. The equation is old and unromantic. The only thing stronger than panic is a buyer of last resort with unquestioned capacity. What then do blockchains actually change? Speed, reach, and composability. Value moves at the pace of code through programmable logic among machines that do not sleep. Global users can hold dollar exposure without setting foot in a bank lobby. New platforms can build lending markets, payments apps, and trading systems that settle instantly and compose like Lego bricks. None of this repeals gravity. Collateral quality still rules. Liquidity profile still defines survival. Operational pipes still determine whether money actually moves when demanded. Governance still decides who must wait and who gets served first. The canvas is new, the physics are not. Practical lessons aren't hard to summarize. Know the species in your hand because the good day behavior can mask a bad day failure mode. A fiat-backed coin with reserves and T-bills behaves one way under stress. A token backed by volatile crypto behaves another. A reflexive coin behaves like a story running out of ink. Raid the treasury, not the tagline. Overnight repo and bills turn into cash quickly. Corporate paper and longer bonds don't cooperate during fire drills. Redemption beats rhetoric. Accessibility, when it counts, is policy, not marketing. Who is allowed to redeem, at what size, through which pipe, on which days? Assume pipes break, banks can close, oracles can lag, chains can clog. Design portfolios and processes for the hours when everything is late and nothing is certain. Diversify rails. More than one stablecoin, more than one chain, more than one custodian. Single points of failure fail at the worst moment. Treat yield with suspicion because yield has a surname, risk. If a token pays handsomely, look for the duration, the credit, or the structural bet that funds those pennies. Step back and a deeper pattern appears. Stablecoins promise the oldest dream in money, freeze value while the world moves. The gold peg tried, the Bretton Woods promise tried, currency boards tried, money funds tried. This time it's pegs on a blockchain. The dream is not absurd. Commerce needs calm. Households and firms need a unit that doesn't swing like a chandelier. The goal isn't to eliminate volatility, it's to cage it long enough for real work to happen. On good days, the cage feels solid. On bad days, the animal remembers it has teeth. There's another truth that unites eras. Pegs do not die because math is hard. They die because confidence blinks. Confidence is not irrational. It is a read on the mix of collateral, policy, and competence sitting behind the promise. When that red turns, speed becomes the enemy. The very quality that makes on-chain dollars useful, instant transfer, also lets doubt spread in milliseconds. The cure isn't slower networks or prettier dashboards. The cure is credible collateral, transparent books, robust pipes, and a standing bid that market participants believe without an explainer thread. Look again at what stablecoins have built in a short time. A parallel dollar network that never sleeps, connecting traders on an exchange to shopkeepers with QR codes, connecting remittances across borders to money robots paying each other by the minute. In countries where the local unit stumbles, this network feels like an escape hatch. In markets where the banking rails move like syrup, it feels like a jet stream. But the escape hatch opens into the same atmosphere that governed pegs for centuries. Import the dollar's stability, and you import the dollar's politics. Drift away from those politics, and you sail into seas patrolled by market squalls. In one direction lies blacklists and compliance. In the other, volatility and Darwin. The rhetoric around decentralization often treats trade-offs as heresy. The peg doesn't care about rhetoric. It cares about two questions: what backs you, and who stands behind you when the tide goes out. Code is law, may define how a contract behaves, but it does not define whether collateral clears at par under pressure. The tokens that understand this, by over-collateralizing conservatively, by shortening duration, by maintaining real-time transparency, by cultivating deep and boring banking relationships, will live to see many cycles. The tokens that forget it will trend toward the fate of all elegant ideas that mistook belief for balance sheet. There is a final irony worth noticing. By turning dollars into tokens, stablecoins have also turned collateral into code and code back into collateral. The line between on-chain and off-chain has blurred. Treasury bills, the safest short-term assets in the world, now underpin a layer of programmable money that can zip across continents in seconds, embed in an app with a few lines, and settle without permission. That is not trivial. It may be one of the most consequential upgrades to the dollar's distribution system since ATMs, but consequence does not equal invincibility. Peg once meant a promise backed by metal. Today, it means a promise backed by buyers. When someone says, "Don't worry, it's always $1," remember what history whispers: only while confidence lasts. Keep an eye on redemption, on reserves, on governance, on the quiet market makers who actually take the other side. The modern system has pushed trillions through invisible scaffolding that looks like code, but behaves like a money fund in a storm. When the sun shines, everything works. When clouds gather, the window matters more than the website. The coins that survive will be those that treat the peg as a living organism in need of oxygen, not a permanent fact carved in stone. For users and builders alike, the mandate is simple. Treat stablecoins as tools, not as truths. Understand that every peg is a trade, a bargain between speed and certainty, access and control, convenience and oversight. Diversify that trade. Test it. Plan for its failure in the same way engineers plan for ships to meet waves. Celebrate the calm, but respect the tide. The long game is not to abolish volatility, it is to domesticate it. On a good day, the cage is quiet. On a bad day, the roar returns. Know what feeds the animal. Know who holds the keys. If the insight lands, act on it. Read the treasuries. Watch the pipelines. Question the yields. When the story changes, don't argue with the math. And when a peg wobbles, remember the oldest lesson in finance. The first exit is cheaper than the second. A stablecoin is a promise wrapped in code. Some promises hold, some don't. The difference was never magic. It has always been mechanics.